Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
What if the biggest financial illusion in your life isn't the price of your house, the salary you earn, or even the inflation you complain about, but the very nature of money itself? What if the cash in your wallet, the numbers in your bank account, and the wealth you believe you own are not what you've been led to believe? And what if the real story of money creation, the story almost no one talks about, is stranger, more fragile, and more engineered than any global conspiracy theory? Most people believe money comes from two places: governments printing it or central banks issuing it. But the truth hides in the gray space between those explanations. In a mechanism so counterintuitive, so deeply embedded into modern life, that you could live your entire life participating in it without ever understanding it. Today, we go into that hidden world, not the world of bank vaults filled with gold bars, not the world of politicians approving budgets, but the invisible architecture that decides who gets wealthy, who stays poor, and why the entire global economy behaves like a machine built on promises instead of resources. And once you understand how money actually comes into existence, you'll never look at debt, banks, financial crises, or even economic growth the same way again. Before we get there, we need to rewind farther back than you'd expect. Because the story of money creation isn't modern. It didn't start with the Federal Reserve. It didn't start with the gold standard. It started with a simple human weakness, the desire to trade, without the burden of carrying things. Centuries ago, trading was direct. If you had grain and your neighbor had wool, the deal was simple. But as societies grew, bartering became slow, unpredictable, and limiting. People needed something portable, durable, and widely accepted, so gold stepped in. Gold didn't just have value because it was shiny. It had value because it was scarce, hard to fake, and trusted across cultures. But even gold had a weakness. Carrying it around was dangerous. Enter the goldsmiths. They originally stored gold for people and issued paper receipts that represented deposits. These receipts were lighter, easier to trade, and soon became more popular than the gold itself. People trusted the receipts more than the metal they represented. Goldsmiths realized that only a fraction of the deposited gold was ever withdrawn. And this is where the first twist in human finance emerges. They started issuing more receipts than the gold they physically had. In other words, they created money out of nothing. But it worked. As long as everyone didn't demand their gold back at the same time, the illusion held. This, centuries later, became the foundation of the modern economy. Fractional reserve banking was born. The idea that banks can lend out multiples of what they actually possess. The idea that debt can become money. The idea that wealth can be created simply by writing numbers on a ledger. But this system also planted a time bomb, because if confidence ever collapsed, the illusion would collapse with it. Fast forward to the 19th century. Nations were expanding. Their trade, industrial machines were transforming entire continents. And the demand for money was exploding. Gold was too slow to mine, too rare, too rigid. Economies needed more money than gold could support. And financial institutions grew increasingly creative with their liquidity solutions. In 1913, The United States created the Federal Reserve, an institution designed to stabilize the economy, prevent panics, and manage the supply of money. But it also created something else, a central authority that could issue money, not based on physical resources, but based on lending, expectations, and policy decisions. There's a moment in history that rarely gets enough attention. Money stopped being a thing and became a system. It became elastic, expandable, adjustable. Money became something that could be created through debt. And then came 1971, when President Nixon officially detached the US dollar from gold. This moment turned every major currency on Earth into fiat money backed not by metal, but by government decree and collective belief. People think this meant governments simply printed money, but printing is a tiny fraction of the story. The real creators of money were, and still are, commercial banks. Here's the part nobody talks about. When a bank gives you a loan, it doesn't use money from other depositors. It doesn't take cash out of a vault. It simply types numbers into your account. That new balance, those digital numbers on your screen, are new money, created at the moment of lending, not transferred, not moved, created. When you take a $300,000 mortgage, the bank doesn't have $300 zero stored somewhere with your name on it. It manufactures it instantly, and that money enters the economy through you when you pay contractors, sellers, furniture stores, or anyone else. The money spreads through the system like a ripple, and when you repay the loan, the money disappears. It returns to the void from which it came. This is why modern economies are addicted to debt. Without borrowing, the money supply stops expanding. Without expansion, the economy slows. Without growth, the entire system starts suffocating. In a sense, debt is the oxygen of the financial world. But oxygen is also flammable. Let's zoom forward again, this time toward the 21st century. The global economy has become a complex ecosystem of digital money, algorithmic trading, credit creation, and interconnected banks. But the underlying mechanism hasn't changed since the goldsmiths. Confidence-based money expansion, and whenever confidence cracks, the system trembles. The 2008 financial crisis wasn't just a housing market collapse. It was the moment the world realized how much money had been built on debt derived from other debt, backed by predictions about even more debt. Layer after layer of promises, with almost no real wealth underneath. When those promises turned out to be worthless, trillions of dollars didn't evaporate. They simply ceased to exist, because they had never been real in the physical sense. They were numbers created through money creation mechanisms that collapsed under stress. Yet governments responded not by reforming the system, but by doing something unprecedented. Quantitative easing. Central banks began buying assets with money they created digitally, injecting liquidity directly into the system. It worked, but it also cemented a dangerous rule. Whenever the system crashes under the weight of its own debt, central banks will create more money to rescue it. We entered the era of artificial financial stability, one held together by interest rates, bond purchases, and the hope that people trust the system long enough for it to survive another cycle. Here's where it gets even more interesting. Modern money creation has detached so far from reality that global debt has now exceeded $300 trillion. That's more than 3 times the world's entire annual economic output. For every $1 that physically exists, banks have created many multiples in digital credit. This isn't a glitch. It's how the system functions. But every system with limitless expansion eventually faces a limit, the breaking point. And you can already see the pressure building today. Rising interest rates expose how fragile the architecture is. People default. Businesses cut jobs. Governments face higher borrowing costs. Banks pull back on lending. And when lending slows, money creation slows. And when money creation slows, economies contract. We're watching the same cycle that triggered 2008, 1987, 1973, and even the Great Depression, just dressed in modern technology and global interdependence. But here's the part that reveals the real hidden world of money creation. Every financial crisis is not just a collapse, it's a reset. A clean slate for new rounds of money creation, a chance for the system to expand again. This is why financial crashes happen in cycles, not random, but structural. The system expands until it becomes unstable. It collapses, then rescued through new waves of money creation. Repeat, again and again. Now here's the twist most people never realize. The people who understand this system don't fear recessions. They use them. They know crashes are liquidity events, opportunities to buy assets when the system resets and liquidity is reintroduced. They understand that in a world where money is created from debt, those closest to the source of new money always win. This is why wealth inequality keeps growing. It's not because the rich are smarter. It's because they operate inside a system where money creation itself is unequal. Banks create money when rich people borrow to buy assets. Banks create money when corporations take loans for expansion. Banks create money when governments issue bonds. But when everyday people need money, they get higher interest rates, stricter rules, and less access. This imbalance compounds over time, creating the illusion that wealth naturally flows upward. It doesn't. It's pushed upward by the mechanics of the system. Now let's connect all of this to your life today. Why does everything feel more expensive every year? Why does housing rise faster than wages? Why does the cost of living grow even when productivity increases? Why do governments constantly debate debt ceilings as if they're negotiating reality itself? Because modern money creation guarantees one thing: inflation is not an accident. It's a requirement. If money supply stops expanding, the system collapses. If it expands too fast, people lose faith in its value. Central banks walk a tightrope between too little and too much, and you live inside the consequences of every step they take. Now you understand the hidden architecture. You understand the mechanism that shapes economies, elections, global trade, and even wars. But what do you do with this understanding? First, realize that money is a system built on trust, not resources. If trust declines, everything changes fast. Second, understand that debt is not just a personal burden, it's the engine of the economy. Managing your own debt strategically is the only way to avoid being pulled under by the larger cycles. Third, know that wealth in the modern world flows to assets, not savings. Because savings lose value as the money supply expands, but assets, real estate, businesses, investments capture the benefits of money creation. And now we reach the final warning. The world is approaching another turning point. A moment when governments, central banks, and financial institutions will need to reinvent the system again. Digital currencies, new forms of liquidity, tighter controls, or an entirely new structure of global money. Something is coming. And when it does, those who understand money creation will navigate it with clarity, while everyone else will be shocked by how quickly the rules can change. If you want to understand not just money, but power, influence, and the future of the global economy, this is where your learning starts. Money is not what you think it is. It never was. And the next decade will make that clearer than ever. If you found this eye-opening, make sure to like the video so it reaches more people who have no idea how the system around them actually works. Share it with someone who still thinks money is printed on paper. And subscribe if you want to go even deeper into the hidden forces shaping your life, your wealth, and your future. Because understanding money isn't just knowledge, it's survival.